Welcome, everyone. Thank you all for joining. We'll give folks just another minute or so to join. We'll start in just a moment. Again, thank you everyone for joining. We'll give folks just another moment or so to join, and we'll get started in just a minute or so. All righty, we can go ahead and get started. So thank you everyone for joining us on behalf of the University of California, Riverside. Thank you for tuning in today for our Life After College event focused on financial literacy. My name is Brock Cavett, he, him, his, and I am the Director of Young Alumni Engagement here at UC Riverside and our Alumni Association. Life After College series is a new series focused on supporting recent graduates and young alumni in the transition to life after college by focusing on life skills that are not always taught in the classroom. For today's event, we're excited to be joined by a UCR alumna who will share her expertise to help you gain a better understanding of what financial literacy is and how to best manage your money responsibly. This program is made possible by the UCR Alumni Association and the UCR School of Business. I encourage you to take advantage of all the great things the association has to offer, from our virtual events, our in-person events, to getting involved with your local alumni network. Visit alumni.ucr.edu to learn more. Throughout today's session, you'll have an opportunity to ask questions of our speaker by clicking the Q&A at the bottom of your screen. We'll try to answer as many questions as possible during the second half of today's event. For your reference, we will be recording the session today and we'll send it out after the event in a follow-up email. We'll begin today's event by learning a bit more about our panelists. We'll then move into a conversation where we'll address your most pressing questions. So we're now going to kind of shift to our conversation and get to learn a bit more about the alumna joining us this afternoon. I'm pleased to be joined by our special guest speaker, Tina. I'm going to start with a few of the questions we received in advance of the event, and then we'll then shift to addressing the questions from the Q&A. I now have the privilege of welcoming our guest speaker this afternoon. Tina, again, thank you for joining us. We're so excited to have you. Would you begin by introducing yourself and sharing with our attendees a bit about your background, including how did you know you wanted to go into finance and build your knowledge and skills in this area?
Yes, Brock, glad to be here. My name is Tina Tonnu. I am a pricing and reporting manager at City National Bank. I've been working there for about close to now my coming to my fifth year. It's fantastic to be at the bank. I do a lot of reporting and pricing on a variety of different products, from mortgage loans all the way up into treasury products. So it's a gamut of things that I work with. In terms of how I kind of knew that I wanted to go into the finance or even the business route was I actually had a career switch. I was wanting to be a medical student and decided that that was not for me and I wanted to go into business. And that's when I decided to kind of do a career 360 change. And that's, I started my career search and I wanted to really understand and get the knowledge of what is business. And so that's when I decided to sign myself up to a business background with a degree. And I joined UCR MBA program in 2017. So it's since then it's kind of propelled me into what my career is today.
Thank you for sharing, Tina, and I'm so glad that the UCR School of Business had made such an impact on your career trajectory. Before we move on to our prepared questions, we do have a representative from the UCR School of Business here to share a bit more about their programs and kind of the experience that Tina has gone through. So we're really excited to have partnered with the School of Business for today's event and excited to introduce Abigail Wheeler.
Thanks, Brock, for collaborating with us on this session today, and a big thanks to our amazing MBA alumna and panelist, Tina Tonnu. My name is Abigail. I'm Assistant Director of Graduate Admissions at the School of Business. Today's topic on financial literacy is so important, especially in today's economic climate. In the school and at the School of Business, We are passionate about equipping students, individuals with the knowledge and skills to be successful in business, no matter what industry you may be operating in. I'm quickly going to share my screen and just share with you a little bit about our graduate programs and who we are, what we offer. So UCR School of Business is home to the A. Gary Anderson Graduate School of Management. We are a business school that lives at our values. We value integrity, inclusion, innovation, and collaboration. And we hope that those values are evident to all who experience us. We do offer 4 degree offerings and 5 programs. If you're looking to get into the business world and want to prepare yourself to be a future business leader or manager in whatever sector, then an MBA degree might be a right fit for you. We have 2 MBA program offerings. One is a full-time MBA that would take 2 years typically to complete. Another is a part-time offering, which we call our professional MBA program. Some students take between 3 to 5 years to complete the professional MBA, depending on their level of work that they're committed to in their full-time career. For MBA, we do have 1 year. In the first 1 year, you'll take a variety of management courses in all different sectors of business, and in the second year, you do get to concentrate in whatever area might be most interesting to you, whether that's finance, accounting, supply chain management, marketing management, or information systems. If you already have a particular passion in a specific area like finance, accountancy, or business analytics, and you really want to build skills in those areas, then we do also have 1 year specialty master's programs, our MFin, MPAC, and MSBA. Our business analytics is a very hot field, so we do recommend, if you're interested, to get in it as soon as you can. Here's just a quick look at our MBA class profile. We have a very diverse group of individuals in terms of gender, nationality, ethnicity, and academic background. We accept students from all academic majors, and it provides a lot of richness to our cohort. We do have a test optional admissions policy, which means you don't need a GMAT or a GRE score, but if you submit it with a good score, it can increase your competitiveness. Likewise, if you have a lower GPA or little to no work experience, then we do recommend you do take those scores. At the School of Business, we have a dedicated career development center for our graduate students. Our graduates are getting great jobs at top companies like these here on the screen. We have an easy application that you can complete. You only need a resume, a statement of purpose, your transcript from all academic backgrounds, 1 letter of recommendation, and your test scores if you choose to submit them. Upon the time of review of your application, we also provide scholarships. So we do give generous scholarships, especially to UCR students. And there are other funding opportunities available as well, such as a teaching assistantship or military benefits. So don't let that price point hinder you from pursuing your dream and getting to the career that you want to be at. Here's our admissions team, and please do take down my email, my first name dot last name at ucr.edu. I'd be happy to connect with you and get you set up for a personal consultation. I'm going to go ahead and pass it back to Brock and Tina, and I'm really grateful to be here with you all today and looking forward to the content of this session.
Perfect. Thank you, Abby, for joining us and for all of your help on today's event. You'll receive more information on the programs that you just heard about in the follow-up email. So now it's time to dive into some prepared questions that we have for Tina to kind of really get our conversation started. But remember, we want to hear from you. So please feel free to submit any questions that you have using the Q&A feature at the bottom of the screen. Again, we'll try to get to as many of your questions as possible throughout the session. So at any point throughout the session, go ahead and start submitting your question. But Tina, we'll go ahead and start off with, just you give us a background, of what financial literacy is, just so folks have a good overview of what that looks like.
Yeah, of course. Financial literacy is in a nutshell, it's having the knowledge and skill sets to really understand a lot about your personal finance. And then we bring it back, you can start from the very most basic things such as understanding your budget. What does your spends look like each month? And it goes all the way to how do you build credit? What is credit? To very complex things like how do you even create an investment portfolio? How do you save for retirement? So it's really really understanding about individually, personally, what does your financial circumstances look like, and how do you understand those risks, and how do you make sure that you can build wealth at a age and so that you can retire and live a lifestyle that you would want.
Thank you. That's helpful. And I think definitely something that everyone is really excited to learn about and really wanting to learn about with everything currently happening, And so that kind of leads to my next question of, how can folks best prepare for large economic changes such as inflation or recession, things like that? Obviously, there's been a lot of talk about those things happening. What can folks do to best prepare?
Yeah, I get that question a lot, especially working at the bank. And when people ask, what do you think the market's going to look like with rates and inflation being kind of those drivers? If I knew exactly what to say, that would be the $1 million question. But in a personal, at a financial standpoint, it's really understanding what is the power of your money, right? What can you get for a bang for your buck? With inflation, one of the bad things about inflation is if you just leave your money, in a bank or it kind of just in a savings account, it's not really earning anything. And if anything, it's going to actually lose value because if inflation is really high, the amount of interest that you get is not going to enough to cover the inflation that is happening. And you see that a lot with a lot of people. One of the mistakes that I see is that people say, "Oh, I'm putting my money in my savings. I have a lot of my savings. I'm great. I'm prepared." But what they don't know is that for most banks, their savings rate is very low, right? It's about 1 or 2 basis points or 0.03% at most, right? And that's not really enough to even cover inflation, let alone create any sort of wealth. But in terms of inflation, a lot of the things, if you do have, money lying around or you have some extra savings that you saved up, I think one of the best things you can do with inflation is to invest in real estate. I don't want to be, a real estate guru or anything like that, but investing in real estate, why it is so important is because it's actually an inflationary hedge, meaning when inflation goes up, the value of your property also goes up. You're able to charge more with rent if you're willing to rent out your property. And so that's why it's such a good investment tool that you can use during times of high inflation.
Perfect. That's really helpful. And like you said, there's obviously no great answer right now, but that's a great kind of starting point for folks. And so really appreciate that. So you mentioned a bit ago about credit and that's a big piece too of financial literacy. What advice do you have for folks regarding credit? How to build it? What's some of the the credit cards? A lot of folks don't know which one is the best one or what that looks like. Can you share a bit about kind of credit, what that looks like?
Yeah, of course. Credit is think of it as all the loans that you have, right? That's all forms of credit. And for me, when I'm talking about credit, and we're talking about someone who either just started school as a graduate student, or someone who just recently graduated school and is now an alumni and is going into the workforce. One of the big, I would say, credit that they have is through student loans, right? And so student loans is probably one of the biggest credit or loans that you have in your earlier career stages. And it's actually not that bad. People have really misconceptions about having loans or having some sort of credit. And I would say that's a bad thing. Having loans is actually not a bad thing. And in order to build credit, think of it as like the initial credit that you have before a big purchase, like a mortgage or a house later on in your life. So building credit I would say the initial one would be starting with the student loans, or even with, purchase of a car. That's how you can start building credit.
So we actually have a question that just came in, and I am actually going to push it through now because it has to do with what you were just talking about. You mentioned obviously housing and real estate's a great way to kind of fight inflation, but how do I get housing without credit is the question that we just received.
How do you get housing without credit? When you say credit, as in like you have poor credit or just no credit in general?
They didn't specify, so I'd say just maybe if they haven't quite built up a high score yet, or if they're not quite, maybe they don't have student loans or credit card and don't have much of credit yet. How do they go about housing if they don't have it yet?
Yeah, so there's actually some, when you get to the nutshell, I was gonna get to later, but when you start investing, there's actually a variety of tools that you can invest in that's very diverse, and that meets kind of what this person's question is regarding. You can get exposure to real estate without actually having to purchase a property. You can do it in a variety of ways through like a REITs, which you can purchase. It allows you to invest in a share of a large real estate portfolio. You buy a portion of it. You really don't need to have credit. So there's a lot of investment vehicles out there that grants you real estate exposure without having to directly invest in real estate. And so when I said earlier about investing in real estate as an inflationary hedge, it's not actually having to actually purchase the property. It's as long as you have some sort of exposure to it in your investment portfolio, that's actually good.
Perfect, thank you. So, sticking with the credit conversation, if folks do have bad credit, whatever reason that may be, how can folks repair that and maybe help increase their credit score?
I'd say the majority of the question would be time, right? It's think of a credit score is basically a bank's judging how risky you are as a borrower, right? And so when you're not paying your bills, or if you have a poor credit score, the bank's gonna think, oh, this person is very risky in terms of a borrower. And so you really need to have that time in order to be able to repair that credit history that you may have poorly. Maybe you've missed 1 or 2 payments of a credit card. So time is really, think of it as a way for us to understand whether or not you are able to, willing to pay back your credit. Another thing I'd say is it helps building with credit is with your employment, right? And so one of the things is one way to a bank to register whether or not you're a risky borrower is to understand, are you able to pay back your loans through employment, how much money you have in your bank, things like that are best ways to understand and repair bad credit. But I would say the most important answer would be time. It takes time. I think if you have a mark on your credit score, I think it takes about 5 or even 7 years to remove that missed payment. So it does take a lot of time to kind of build that credit back.
Perfect. So kind of, you started talking about student loans. So kind of in a similar vein, for folks that have student loans, what is your advice to most efficiently pay those off? Is there a certain amount? I know we're also in a weird space right now where a lot of them are paused and have been paused for a while. So kind of what advice do you have for those with student loans and the best way to kind of, pay those off in a way that helps credit, but then, in the long term helps them as well?
Yeah, I would say refinance, please refinance if you can. And it really depends on the interest rate environment. So now I would say you cannot refinance because rates are going up. I know the Fed just increased its rates last week. But I think a couple of months previously, the rates were at a low, so you refinance. But there's going to be times when rates are going to go back to a very low rates, and that's when you should start thinking about refinancing. But even before refinancing, I think the most critical is reconsolidation. And what I mean by reconsolidation is when you have a student loan, you're not just borrowing from one lender, right? You're borrowing from multiple multiple lenders out there. So it could be from the US Department, even for the US Department of Student Loans, you got your federal and you got your state. So you have a variety of lenders that you're borrowing from. And then you also have private loans if you may have, if you're an out-of-state student, or even if you're an international student, you have loans from a variety of different lenders. Where consolidation really helps with kind of putting that together, and it's really a simple way to kind of manage all your loans out there. You pay one bill at the end of each month at the same time. There's what I did for me personally, from my experience, was after I graduated my MBA, I was hit with all these student loans that, were in forbearance and were in kind of a grace period where you didn't need to pay. And, after I graduated, I think a few months later, I got 4 or 5 different bills saying, here's congratulations for graduating, but here's your student loans and the X amount. And there were a lot of them from different lenders out there. And so I think what you could do first is to look at, there's different banks out there that provide really good rates for reconsolidation, because they do want to invest in you. And the reason for that is they know students who've graduated have a potential to earn higher. And so they do want you to be part of their client base. And so they offer really, low rates for you to either think about reconsolidation or even refinancing with them. And that's actually a great way to actually start building credit, right? It's when you reconsolidation all of those loans, and you can start creating that connection with a bank that may actually be the bank that you bank with, and have even an investment portfolio with them later on as you kind of start your career later on.
That's really great, and I really appreciate that really kind of good understanding of reconsolidation. Just for folks that maybe don't, have a very basic understanding, can you share a bit more about really what refinancing looks like and what that process is, just on a kind of basic level?
Yeah, refinancing is basically, think of it as you actually start from scratch, right? Basically, you redo the whole loan process. They go through an underwriting, credit history on who the borrower is. Refinancing is just a term that we use when we want to think about lowering rates, but refinancing could be when you have better credit. A lot of people who end up building credit and have a better credit history want to refinance their loan. It also means you can just change your loan agreements, whether it's you want a shorter loan or you want different payment options. That's also an idea. It's not just for a lower rate, although when we think about refinancing, it's about lowering the interest rate on your previous loan. But in terms of the process, it's like starting a loan from scratch, right? It's the whole, you go through the whole loan application process.
Perfect. Thank you for that kind of understanding of what that term even is. We do have a question that came in from our audience that I do want to push through to you, since it does talk about what we were just discussing regarding refinancing a loan. So are there any dangers or things to look out for when refinancing a loan?
Can you repeat that? Dangers or
things to look out for?
Things to look out for, dangers. I wouldn't consider it danger or anything like that. But there are some things you should want to consider. A lot of the times when you're either refinancing or starting to reconsolidate your loans, most banks do, because you don't have either you don't have a good credit history just yet, or you just graduated and all you have are loans, right? They do require you to have a deposit. And when I say deposit is, let's say you want to get a loan and they say you need to put in 10% of that in their bank as a way to, for them as a risk mitigator. And then also a lot of the banks will also require you to put a direct deposit. So let's say you're starting to work, they're going to say, okay, we can give you a really good rate, but here's the requirement. You need to put 10% of your loan into our bank. And then every month, whenever you get your paycheck, it has to go directly to our bank. So that's actually a way for them to reduce the amount of risk and really understanding that you're going to pay back those loans.
Perfect, thank you. So looking at just, in your experience working with folks and their finances, what would you say is one of the biggest mistakes that you see people make regarding their finances?
I would say starting too late. And I think this is the misconception a lot of people have when it comes to investing or, putting money into aside for retirement. They think it's too early, right? They're like, oh, I'm not going to retire until 30, 40 years from now. I still have long ways to go. I don't need to think about it just yet. And I think that's one of the misconceptions, is starting too late. Or they're thinking, oh, I don't have a lot of money I've saved up, so I really can't really start an investment portfolio if I only have, let's say, maybe less than $10,000, right? I think that's actually something that you should try to get around it, because starting early. I know if there's any finance students on this call right now, you'll know the power of the time value of money, right? So even if you put aside a little bit of money into a portfolio or even to a high savings rate account, actually will build up. And with the time value of money, it's little, but you have that time power on your hands. And the other one would be it allows you to have a more diverse portfolio, because with the amount of time that you have until you retire, you can invest in a lot more riskier investment options. For instance, like real estate is one of them, right? You really need to have a long time horizon for that to be appreciated in value.
Perfect, thank you. Yeah, I think that time is a huge piece. Yeah, folks don't realize it until it's not too late, but until you're already behind. And so that's a great piece of advice I definitely agree with. You started talking a bit about putting money into retirement and things like that. Can you share maybe a bit more about what that looks like for folks that maybe are on our call and they're working on their first job? I know myself, I had no clue what I was doing when I was picking my retirement plan, and if I was going to contribute or my employer was contributing to. So can you share maybe a bit more for folks that maybe are recent grads and are in the process of getting that first job, what retirement plans look like when they're looking for a job, and maybe some smart decisions they can make when setting that up?
Yeah, of course. So with retirement and retirement contribution, it really depends on your company. I think most companies now, they do offer what we call a defined contribution plan, meaning you contribute and then they do a match. So for instance, like what my employer does is we contribute, let's say 10%, and then they match it to how much to an X percentage. And the good thing about that type of option is you really can, there's a couple of options. You can be very risky. You can invest in a lot of really risky investment options, or you can be kind of on the safe side. There's like a range in terms of what you want to invest in, and you can kind of tweak those proportions or allocations as you deem fit. But in terms of contributing, like how much you should contribute, whether you should contribute, I would say the good thing about the matching is that it's kind of like free money, I would say, right? Your employer is contributing, so you should kind of max it as much as possible. There's actually different options out there. There's what we call a Roth IRA. I really like that type of investment portfolio type, because it's actually tax deductible. Your money doesn't get tax expensed. So that's kind of one advantage for using that. I think something you should really research on is the Roth IRA. And then even in addition, if you do have additional money even after you contribute, and let's say you're not spending a lot each month, I would say really look at, there's a variety of kind of local private banks out there that you can start opening an investment portfolio and contributing. There's really no correct answer on how much you should contribute, Like it really depends on your personal circumstances. You have a family, I know it's hard to contribute a lot, especially you need money each month for that. Or if you don't have any dependents, you can save more. For me, I save, there's no really a good answer, but for me, I save about 20 to 30% of my paycheck goes into a portfolio, whether it's a Roth IRA, it's a retirement 401k, or my own investment portfolio.
Thank you. I know that's helpful, and I'm years out from college and still don't always understand. So I really appreciate that clarification. Just a reminder, in a few minutes, we'll be switching to fully answering your questions. So we've got quite a few already. So reminder, any questions you have, submit to the Q&A. We'll get to those in just a moment. But we do have lots of folks here. Life After College is really focused on folks that are within, those 10 years out of undergrad. So a lot of it is new grad. So, what does a realistic budget really look like for someone, within that 10 years out of college?
A realistic budget. Like I said, it really depends on your personal circumstances, right? And can you clarify, what do you mean by having a budget? Like how much money you have each month, or how much money should you spend?
Yeah, like, spending, savings, I think is the big one. I know you talked about the difference between, a savings account versus investing in property. So, in that first 10 years out, at that point, should folks have, an investment in property? Should they have a couple of thousand in their savings for, emergencies? Just kind of what should a person's financial situation, an ideal situation, look like within kind of that first 10 years, just so that folks are set up for success in the future?
Mm-hmm. Yeah, so I feel like in the first 10 years, you probably either towards the tail end or even just towards the middle of paying off your student loans, right? So that's going to be the first chunk of your expenses each month. In addition to maybe, I'll say, a car payment. If you just purchase a car to drive to work, that's another big chunk right there. And then for those that are very first starting, you maybe there's a few individuals out there that just purchase their first property, right? And because they're creating a family, I think 10 years out of college, it depends on if you're an MBA student or if you're an undergrad. If you're an MBA student, you're probably starting a family. If you're an undergrad student, you're thinking about actually going to maybe additional schooling, maybe go back to business school, or even going to graduate school. So maybe not purchasing properties might not be a good option for you because you're probably having more loans, right? So it depends on where you want career-wise. I would say when your career is more stable, meaning you know where you're going, you have either started your first job and you know that that's the company that you're going to grow in, or that's exactly the career that you want. That's when I think you should start really looking at investments, right? Because you're a little bit more stable, right? You know what your income's going to look like for the next 10, 20 years. And then you can start really planning. And that's when you might not be a bad idea to make a phone call to a financial planner. Maybe that person really can help you understand, okay, in 10, 20 years from now, what your circumstances look like. And what are your goals, right? Maybe your goal is to go to Europe every year, right? Maybe that's going to be part of your trajectory. Or maybe you want to buy a property, a very nice property 10 years from now. So maybe that's when you should start looking at talking to a financial planner.
All right, perfect. Well, now we're going to start switching over to some of our questions from the audience. So again, continue to submit your questions. We'll try to get to as many of them as possible. The first one is, I recently got a new apartment and they mentioned that I have too new of a credit score. When will my credit score not be considered new? Will it be a year or longer?
In terms of, can you repeat the last part of the question?
Yeah, so just wondering, when will their credit score not be considered new? They, I want to know when it'll be a little more established when, applying for apartments and things in the future.
Yeah, so I think there's a couple of things that banks look at. It's time is one of them, but it's also a variety of different things. How long have you been working? Your work history look like. Sometimes if you have a really big purchase, you can have a co-signer who is a person who is more established, who has a longer credit history, who can kind of be that person who says, okay, if this person is going to have any sort of problems, I'm going to be there to back that person up. So maybe having a co-signer for the first few years, that might be one option. In terms of time, there's really no clear-cut answer, because there's people who can have really new credit score because they haven't really have any credit. I mean, if the only thing credit that you have is an apartment, that's not really building credit, right? There's a lot of other credit options out there. Either loans for student loans, one of them, or even loans for a business, right? There's a lot of credit things that you can build. Having multiple credits, credit cards, different lines out there is also one of them. But there's really no clear-cut answer on when your credit would be established, right? And then it also depends on when you get that credit, are you being very consistent with your paying patterns as well. Let's say you have only one credit, but you haven't been really consistent paying it off. That's also a sign of risk in terms of for a bank.
Cool. In that kind of same realm, you talked about having, time at a job or whatnot. So switching jobs impacts the employment aspect of having good credit to a lender?
Switching jobs. Actually, no, that is actually not I'll say a sign, depending on if it's a better paying job, right? So sometimes a better paying job actually might be a better sign for a lender. But yeah, I don't think switching jobs is a really sign unless there's a long period of time where you're actually not earning any money. That actually might be a sign of risk. But if you're just switching jobs, yeah, there's really no risk in that regards.
Cool. So as long as they have a job, really.
Yeah, but I think it really also depends on the type of job too, right?
Yeah.
Because if you're switching from a job that you have pensions for, or a very stable job like a government job, to something more like a self-employed job, which you're now like an entrepreneur, that might be a sign of risk. But if you're switching from, let's say, from one company to next doing the same line of work, that there's really no risk in that.
Okay. So other than real estate, what would you say are the next best places to invest in?
Wow. Investments, right? Gosh, there's just so many options out there. I wouldn't say there's really one or two good options, because diversification is such a big thing, right? You don't really want to put your eggs in two types of products. So if I say something, I don't want you to go out and put all your money into that, and then if it loses money, and then it's my fault. But there's I would say if you're looking about putting a small sum of money on the side, I think ETFs are a really good one, exchange traded funds. It's one way where you can get kind of immediate diversification and investing in a small amount of money, and you don't have enough to quite buy a property just yet. ETFs are a good one. I don't know about mutual funds just yet, but I'll say ETFs would be one way to maybe just start scratching the surface. I know a very specific one a lot of people purchase are the SPDR, which is the S&P. And there's different types of ETFs out there, but also ETFs are something you should maybe start looking at.
Okay, thank you. So kind of going back to retirement, can you explain the difference between a pension and a 401k?
Yes. A pension is, in order to get a pension, you need to work for that company X amount of years. So let's say that depending on the company, but let me say, just throw a number out there just for an example's sake. Some companies require you to work, let's say 10 years, and that's when you meet the pension. If you do, let's say, not get to that 10 years, and let's say you only work 7 years and you switch jobs, you won't receive that pension, right? You haven't met that goal. Whereas 401k, if you leave in any time, there's still 401k for the period that you're working for that company. So there's a distinction there. Pensions don't really start until you're kind of more middle management role. If you're starting kind of entry level roles, there's no pensions just yet. I think it's a little bit for middle to senior level roles for a company. Whereas 401k, you start that at the very beginning when you start working.
All right, so this person has sort of a niche question. They're employed in California, but they are in a PhD program in a different state. So they're employed in 2 different states. Do you have any recommendations to lower taxes, or kind of the best process of kind of going through kind of having to deal with 2 different states in regards to finances?
Oh, that's interesting. One thing I could say that there are some states that are more favorable in regards to taxes. For instance, I know Texas and Florida, if you're ever employed there, they don't have state taxes, so you don't need to pay. And it depends on where your employer is though. So even though you live in a very tax advantage state, like a tax haven state, and if your employer or you're based on a state that has high taxes, then you still would have to pay, because it depends on your employer, right? Where your employer, where your work is located at. Yeah, so there's no way to kind of get out of that. But if you do work, I think there's probably some tax savings that you can get for your personal income though. So I don't think that's kind of expertise for me to say about tax regulations, but I would say there's probably some loopholes you can look at.
They are New Mexico, FYI. They did just clarify that they're in New Mexico. So I don't know if that makes a difference yet for you or not.
No, yeah. I'm sorry, I'm not a tax expert. I think you would have to talk to either your accountant or someone who's like CPA. I think that they know more about the state tax regulations than I am.
All right, so you mentioned a financial planner earlier. Would you recommend going to investment managers like Charles Schwab, or would you recommend being largely independent?
It depends on how much of an investment you're thinking about, right? If you have, let's say, thousands of dollars, like hundreds and thousands of dollars, I would say you probably want to go in a more well-known, maybe a Charles Schwab or a Merrill Lynch, kind of those bigger investment. But a lot of times Charles Schwab is not really for an individual who is kind of just starting out. I think there's a requirement. I think you need at least $1 million to start off. But if you're still wanting to invest and you don't have that much, I think maybe looking at your smaller local banks. They do have investment programs out there that is kind of for individuals with a smaller investment portfolio. Because when you go to those more well-known, they're going to charge you a higher fee. So when people talk about investment, it's not just how much you gain, right? You're going to have to pay a fee no matter what. So even if your portfolio is not gaining any money, you still have to pay usually 2 to 3%, or sometimes even 5%, depending on how well known they are, of management fees. So you're going to pay those fees no matter the performance of your portfolio. So just one thing to watch out for is those fees can add up.
Perfect. Moving on, do you have any tips for when considering a mortgage? What are some considerations to shop around different banks and financial institutions to find the best rate?
Yeah, so for getting the best rate, I think obviously shop around, get as many quotes out there as possible. Sometimes banks might not be the only place you can lend. So one thing I say that there's a lot of mortgage shops out there who their only purpose is to kind of lend for mortgage. So doesn't have to be a bank, so that doesn't kind of limit to options out there. But I would also say when you purchase a house, you have to be very time considerate. Like for instance, depending on the circumstances, there's certain times where maybe you shouldn't be purchasing a house. The market's too unstable. Housing prices volatility is really high. Might not be a good time for you to buy a house during that time. So even if you do have the money for it, maybe during that period it's not a good time to buy. For instance, maybe during that period there's not a lot of people selling houses in general, right? So maybe you're not going to get a really good price for it. Or rates are going really high right now. Maybe that's not a good time to buy it. But I would say when you think about buying a house, a lot of things you want to consider is make sure your employment is stable. So you know for sure that you're going to be able to handle that loan, right? It's not going to be for 2-3 years, right? It's going to be for 5, 10, 30 years down the line. So you really want to make sure when you commit to buying property that you're going to be able to pay it off, right? You don't want to file bankruptcy later on or foreclose or any of that. Like you don't want that to be something you do. But then also when you're buying a house, like don't get bogged down by traditional mortgage products. And when I mean that is I know a lot of people when they go buy houses, the first thing they say is, I want to buy a 30-year mortgage, right? Because that's everyone are used to a 30-year mortgage. But there's a lot of different products out there that you can also use. For instance, a 10-1 ARM or a 5-1 ARM IO. There's a lot of products out there that maybe in your circumstance is good for you because maybe you want lower payment, right? Or you want pay more. So it really depends on your circumstances. I would say don't be afraid to go out of the 30-year mortgage option.
As someone potentially looking at buying, that's really helpful. So definitely appreciate that great input. So this attendee is an international student. Do you know if they require people to be U.S. residents before investing, or in your experience, but not really?
You don't need to be a U.S. Citizen to invest in U.S. stocks, but if you are investing internationally, you're going to get tax, at least for instance, your local tax for your country, and then also the U.S. tax. So you're gonna get taxed for both places. That's something you need to consider. There are some products out there that are tax-free, but there's very specific ones you can invest in. But internationally, you're gonna hit with a lot of regulations out there. If you're investing, let's say you're a U.S. investor and you want to invest in, let's say in Brazil or some other country, you're gonna get hit with their regulations as well, not only the state that you're from or country that you're from.
So in your opinion, what is your opinion on the differences between credit unions and a larger corporate bank? Which type of bank would be best and kind of for which situation?
Yeah, so I think, like I said, it really depends on what you're looking out in terms of a relationship to a bank. I know for some people, they don't like big banks because they like going to a bank where, they know all the tellers, right? They like going to a bank where they say, okay, here's my relationship manager. that I've known because that person probably has worked through my parents' portfolio. You've known them, they know you, they know your family circumstances. And so if you're that type of, if you're that type, you maybe want to look at a smaller credit union where there's a kind of a close relationship between you and the bank. Whereas you really don't get that when you go to a more, how do you say it, a retail bank, for instance, like a Bank of America, a Wells, a Chase, where they probably don't know who you are because they have thousands of clients, right? And so there's no that closeness that you will get from, you know, a small mom and pop bank or credit union or a regional bank. So it really depends on kind of what your relationship you want it to look like. Sometimes people don't care. Bank is a bank. They like bigger banks because they know there's going to be, one example is ATMs, right? If you're going in a small mom and pop shop, there's might not be an ATM at every location. But if you bank at, let's say, Bank of America, there's going to be one at every street corner. So maybe that's something you like, convenience. So it really depends. I think some people, they have both. So they have like a relationship with a larger bank for convenience purposes, maybe to ATM, getting money. But then they also have let's say a small investment or savings with a smaller credit union where they invest in. So you can have both.
Perfect. Can you explain the difference between a Roth IRA and a Roth 401k?
They're the same.
Okay.
They're basically in tandem. So Roth IRA it's kind of like a retirement. It's like a 401k. The only difference is this tax deductible at the front. And but you most of the time when you're in with a company, your contributions is at the same. They contribute at the same rate as with if you had a 401k. Yeah, interchangeable.
Right. This next attendee asks, what are some things to look for when seeking for financial planning advice? I've heard something about fiduciary, but not quite sure what that entails. So I think really just looking for, like, the best way to go about seeking this advice and making sure that they are able to explain things in a way that that folks can easily understand.
Yeah, so I could probably give a little bit of like what to expect when you're going to a financial planner, right? Maybe fiduciary is just it's just a fancy term on like kind of regulations, right? But when you're meeting a financial planner, it's basically they want to know a couple things. One is what your current background look like, right? Whether it's your family, how many dependents you have, if you have any, kind of what are all the assets do you have, right? Whether you have a car, you have a house, you have, I'll say jewelry, right? Just all the assets do you have, and then you kind of start planning. They ask you about your aspiration goals, right? Maybe they start off with more immediate goals, right? Maybe you have kids that are going to college in a few years, right? How do you plan on paying that if you do plan on paying those expenses? Then you have kind of more aspirational goals. Maybe like, I want to go to Ibiza every year for the next, I don't know, every vacation, or I want to go to France. Those are more aspirational goals. Then they look at all that and they create a portfolio. They look at, is this attainable, right? For sometimes people come in to financial planners and have, very outrageous goals in mind. Like, I want to be a millionaire in a year from now. Is that possible with only the amount of money that I can invest? So they talk about, really, is it possible, first of all, with what you have, and how long is it going to take? And are you willing to wait for that long? So time is one of them. Risk, are you a risk averse person? I know some people who are really worried about losing money. If they look at their investment portfolio every month and they lose like $1, they feel really sad. Whereas some people are more like, oh, that's fine, right? Are you a risk averse person or not? And that's will tailor to what type of investments that they can invest in, right? If you're the person who's like, I don't want to lose any money at all, maybe they cannot invest in other things, maybe invest in bonds. But really, they look at kind of what your current state look like, what you want to be 10 years from now, 20 years from now, 30 years from now, or even if you want to leave money behind for your kids later on. So financial planning is not just your current state, but future state after, kind of for your kids and later on your next generation.
All right, well, we are rounding out our hour already. This has gone by fast. So before we end our session today, I'd like to ask Tina for a few final words of advice. So, Tina, what's the final thing you'd like to leave our audience with today?
I would say to not get intimidated when we talk about financial literacy, right? I know financial literacy is such a big word, but it's basically just talking about the money that you see every day, right? It's at the end of the day, when I started off with this call, right? It's expenses, right? It's personal things that you do every day, grocery shopping, expenses, how much income you're getting from your job. So it's very, all these things are very personal to you. And I would say to not get intimidated to talk about it, to learn about it. You know, we talk about stocks earlier and about investments. I know some people in the call be like, oh my goodness, that's a lot of information that I wasn't thinking about, tens, thousands of dollars, but just let's just talk about it, right? I think that's the first thing, is just to look at the different options out there and not be afraid to kind of see what you can do with kind of the money that you have.
All right, well, thank you so much, Tina. On behalf of the University of California, Riverside, thank you for joining us today for our Life After College event. It was a pleasure to connect virtually with each of you, and we appreciate you making time to be a part of today's event. Hope you gained some pretty valuable advice. I'd like to thank Tina for her time, generosity, and commitment to UCR and the Alumni Association. Your insights and advice you've shared today are, make all of us especially proud to have you as a UCR alumna. I'd also like to thank the School of Business for collaborating with us on today's event. You'll receive a follow-up email containing a recording of this webinar, as well as a link to Tina's LinkedIn. So if you want to continue to ask questions or to network and connect with her about anything else that maybe you didn't get to ask today, you can feel free to connect with her on LinkedIn after the fact. Please visit alumni.ucr.edu/career services for further details on upcoming episodes of our Life After College series, to view recordings of our past webinars. We also encourage everyone that is here today to sign up for the UCR Career Network. This is a free online networking and membership platform that the Alumni Association launched last year. Highlanders can join by visiting careernetwork.ucr.edu. Another great way to connect with folks just like Tina, who are UCR alumni and are, have some great skills to be able to offer other alumni and students. We're also very excited to be back on campus this fall for our homecoming, our first in-person homecoming in a few years. Hope you're able to join us on November 18th and 19th back here on campus to learn more about all the stuff happening, including our 50th anniversaries of our Chicano student programs, Black, African American, and Black student programs, as well as a concert. Please visit homecoming.ucr.edu. And again, thank you everyone for joining us, and especially to Tina. Hope you all have a great rest of your day.
All right, thank you everyone.